Have you noticed how quickly market sentiment can change? Just weeks ago, gold and silver were trading near impressive highs. Many investors believed the rally would continue without interruption. Then almost overnight, both metals pulled back sharply. Headlines claimed the bull market was over. Traders rushed to lock in profits. Confidence faded. But what if this decline was never the end of the story? What if three powerful forces temporarily pushed gold and silver lower, and those same forces are now beginning to reverse? Today we are breaking down exactly what happened, why prices fell, and why many experienced investors believe the next move could once again be higher. Stay with us, because understanding these three forces may completely change the way you view the precious metals market. Every major bull market experiences periods of correction. No asset moves upward forever without pauses. Gold and silver have always followed this pattern. During strong long-term rallies, investors often mistake healthy pullbacks for permanent trend reversals. History shows that corrections frequently remove excessive speculation before the next phase of a bull market begins. The recent decline in gold and silver surprised many investors because it arrived after strong momentum had already pushed both metals toward important highs. Gold attracted global attention as central banks continued buying large amounts of bullion, while geopolitical uncertainty increased demand for safe haven assets. Silver followed higher as both investment demand and industrial demand strengthened together. Yet despite these positive long-term fundamentals, both metals suddenly lost momentum. To understand why, we need to examine the three biggest forces that pressured prices at the same time. The first force was the strength of the US dollar. Gold and silver are priced globally in dollars. Whenever the dollar index strengthens, precious metals often face temporary pressure because they become more expensive for buyers using other currencies. International demand can slow as purchasing power declines outside the United States. The dollar strengthened because investors expected the Federal Reserve to maintain relatively tight monetary policy, while the American economy continued showing resilience compared with several other major economies. Stronger economic data encouraged investors to move capital into dollar-denominated assets. Currency markets influence nearly every commodity. Gold and silver rarely operate independently from the dollar. While the relationship is not perfect, it remains one of the most important factors every precious metals investor should monitor. The second force involved rising Treasury yields. Government bond yields increased as investors adjusted expectations regarding future Federal Reserve policy. Higher yields provide investors with greater returns from fixed income investments. As bond yields become more attractive, some capital temporarily moves away from assets like gold and silver that do not generate regular income. This relationship has existed for decades. When real yields rise, precious metals often experience pressure. When real yields begin falling, gold and silver frequently recover. The third force involved profit-taking after an extended rally. Every strong market eventually attracts short-term traders looking to capture quick gains. As prices reach new highs, many of these traders begin selling simply because they have already achieved their profit targets. Their selling creates additional downward pressure, which often encourages other investors to sell as well. Once momentum shifts, algorithms, institutional traders, and technical analysts frequently react to the changing trend. Stop-loss orders become activated, trading volume increases, volatility expands. A relatively normal correction suddenly appears much larger than expected. This combination of a stronger dollar, higher Treasury yields, and widespread profit-taking created the perfect environment for gold and silver to retreat from recent highs. However, experienced investors rarely focus only on why prices declined. They ask an even more important question: are the reasons for the decline beginning to disappear? That question may now become increasingly relevant. The US dollar has started facing new challenges. Expectations regarding future Federal Reserve decisions continue evolving as inflation gradually cools while economic growth shows signs of slowing. Markets constantly adjust their expectations based on incoming economic reports rather than waiting for official policy announcements. If investors become more confident that future interest rate reductions are approaching, the dollar could lose some of its recent strength. A weaker dollar has historically provided support for gold and silver because international demand becomes more competitive. Treasury yields have also become increasingly sensitive to economic data. Every inflation report, employment report, manufacturing survey, and GDP release influences investor expectations regarding future monetary policy. Even small changes in expectations can move bond markets significantly. If yields stabilize or begin moving lower, precious metals may receive another important source of support. Perhaps the most interesting development involves investor psychology. During corrections, financial media often becomes extremely negative. Headlines focus almost entirely on falling prices. Long-term fundamentals receive far less attention than daily volatility. Professional investors frequently use these periods differently. Instead of reacting emotionally, they evaluate whether the original reasons for owning an asset have actually changed. In the case of gold, many of those reasons remain firmly in place. Central banks continue purchasing large quantities of gold as part of their reserve diversification strategies. Government debt remains historically elevated across many advanced economies. Geopolitical uncertainty continues influencing global markets. Inflation has moderated but has not disappeared. These long-term drivers remain highly relevant. Silver may present an even stronger long-term story because industrial demand continues expanding alongside investment demand. The world continues investing heavily in renewable energy. Solar panel production remains one of the fastest-growing sources of silver consumption. Electric vehicle manufacturing continues increasing demand for advanced electrical systems. Artificial intelligence infrastructure requires massive investments in semiconductors, data centers, networking equipment, and power systems that all depend upon silver. These industrial trends did not disappear simply because prices experienced a correction. Mining supply also remains constrained. Unlike many commodities, silver production cannot rapidly increase whenever prices rise. Most silver comes as a byproduct from mining other metals, such as copper, lead, zinc, and gold. Developing new mining projects requires years of planning, financing, environmental approval, and construction. This means supply responds much more slowly than demand. Whenever industrial consumption remains strong while investment demand begins recovering, the balance between available supply and growing demand can tighten quickly. That possibility explains why many analysts continue monitoring silver very closely, despite recent market volatility. Gold also benefits from another powerful trend. Central banks continue increasing their gold reserves as they seek greater diversification away from traditional reserve currencies. These purchases are generally driven by long-term strategic planning rather than short-term market fluctuations. Unlike speculative trading, central bank buying often provides steady underlying demand that supports the broader gold market over extended periods. Meanwhile, inflation remains an important variable. Although headline inflation has eased from previous highs, many service sectors continue experiencing elevated prices. Housing, insurance, healthcare, and labor costs remain above historical averages in many areas. If inflation proves more persistent than expected, investors may once again increase allocations toward precious metals as protection against declining purchasing power. The Federal Reserve therefore remains at the center of market attention. Every speech, every meeting, every policy statement, and every economic forecast influences expectations across global financial markets. Investors understand that monetary policy affects currencies, bond yields, stock markets, and precious metals simultaneously. This is why even subtle changes in Federal Reserve communication often produce significant market reactions. The coming months may therefore become especially important. Economic growth, inflation, employment, consumer spending, manufacturing activity, and geopolitical developments will all contribute to shaping future expectations. Markets rarely move because of one isolated event. Instead, they respond to the interaction between many powerful forces working together. For precious metals, investors, that means understanding the complete picture rather than focusing only on daily price movements. The recent correction reminds us that volatility remains a natural part of every bull market. Temporary declines often create uncertainty, but they can also create opportunity for investors willing to focus on long-term fundamentals instead of short-term emotion. One of the greatest advantages successful investors possess is patience. Financial markets constantly move between optimism and fear. During rallies, many people believe prices can only go higher. During corrections, many believe the opposite. Neither emotion reflects reality. Markets move in cycles, and every cycle creates opportunities for investors who remain disciplined. Gold has repeatedly demonstrated this throughout history. During periods of rising inflation, financial instability, banking concerns, or geopolitical tension, investors often return to gold because they view it as a store of value rather than simply another commodity. That reputation has been earned over hundreds of years and continues influencing investment decisions today. Silver behaves differently, which is exactly why many experienced investors find it so attractive. Silver often follows gold during the early stages of precious metals rallies, but once momentum strengthens, silver has historically produced larger percentage gains because its market is much smaller. It requires far less capital flowing into silver than into gold to produce dramatic price movements. That smaller market can work in both directions. Silver often experiences deeper corrections than gold, but it has also delivered some of the strongest rallies ever seen within the commodity sector. Investors who understand this characteristic usually expect higher volatility instead of fearing it. Another important factor involves the growing disconnect between physical demand and paper market trading. Large institutional traders frequently buy and sell futures contracts based on short-term expectations. These transactions can create significant daily price swings even when physical demand remains stable. Meanwhile, manufacturers, jewelers, investors, and central banks continue purchasing physical metals based on much longer investment horizons. This difference explains why short-term price weakness does not always reflect weakening long-term fundamentals. Physical demand for gold remains supported by central bank purchases around the world. Many countries continue diversifying reserve assets while reducing dependence on traditional reserve currencies. This steady buying creates an important foundation beneath the gold market. Silver demand tells an equally compelling story. Global investment in clean energy continues expanding. Solar panel installations require substantial amounts of silver because of its unmatched electrical conductivity. Governments and private companies continue investing billions into renewable energy projects that are expected to operate for decades. Electric vehicles add another powerful source of demand. Modern electric vehicles contain significantly more silver than traditional gasoline-powered vehicles because of advanced electronic systems, sensors, charging components, and electrical connections. As production continues expanding worldwide, silver consumption naturally increases. Artificial intelligence has introduced another unexpected growth driver. Every AI platform depends upon enormous computing power. Data centers require advanced processors, cooling systems, communication networks, and electrical infrastructure. Silver plays a vital role throughout much of this technology because no other metal combines conductivity, durability, and reliability quite as effectively. These industries continue expanding regardless of short-term market corrections. Supply, however, remains far less flexible. Mining companies face rising labor costs, higher energy expenses, stricter environmental regulations, and declining ore quality. Opening a new mine requires many years of exploration, permitting financing and construction. Even if silver prices increase sharply, new production cannot appear immediately. This slow supply response has historically amplified major price rallies whenever demand accelerates. Another signal worth watching is investor positioning. During periods of market optimism, many investors become heavily invested in risk assets like technology stocks, growth companies, and cryptocurrencies. When uncertainty begins increasing, some of that capital often rotates toward defensive assets, including gold and silver. Portfolio diversification becomes especially important whenever economic uncertainty rises. Many professional wealth managers recommend maintaining exposure to several different asset classes rather than concentrating investments in one area. Gold and silver often serve as valuable diversification tools because they may perform differently than stocks or bonds during changing market conditions. The Federal Reserve will continue playing a central role in determining market direction. Every inflation report influences expectations regarding future interest rates. Every employment report affects projections for economic growth. Every policy meeting provides new information that investors immediately analyze. If inflation continues moving lower while economic activity gradually slows, markets may increasingly anticipate future monetary easing. That expectation alone could provide meaningful support for precious metals even before actual interest rate reductions occur. However, investors should also remember that markets rarely move in straight lines. Even during powerful bull markets, corrections remain completely normal. Gold experienced numerous pullbacks during previous long-term rallies before eventually reaching new record highs. Silver followed similar patterns while often displaying even greater volatility. Short-term price movements should therefore always be viewed within the context of broader economic trends. Another important development involves global geopolitical uncertainty. Conflicts, trade disputes, energy security concerns, and changing international alliances continue creating uncertainty across financial markets. Whenever uncertainty rises, investors frequently seek assets that have historically preserved value during periods of instability. Gold has consistently benefited from this behavior. Silver often joins the move once broader investor participation begins increasing. Many analysts also continue monitoring the relationship between inflation-adjusted interest rates and precious metals. Real interest rates remain one of the strongest long-term drivers of gold prices. When inflation exceeds investment returns on traditional savings, many investors search for alternative stores of value. Precious metals frequently become attractive under these conditions. At the same time, government debt continues expanding across many developed economies. Servicing that debt becomes increasingly expensive whenever borrowing costs remain elevated. Policymakers therefore face difficult choices between controlling inflation, supporting economic growth, and maintaining financial stability. These challenges are unlikely to disappear quickly. Instead, they may continue influencing precious metals markets throughout the coming years. The combination of persistent inflation concerns, elevated government debt, central bank, gold buying, industrial silver, demand-limited mining supply, and evolving Federal Reserve policy creates a remarkably supportive long-term environment despite recent market volatility. This does not guarantee immediate price increases. Markets will continue reacting to economic reports, political developments, and investor sentiment. But the underlying investment case for both gold and silver appears far stronger than daily price fluctuations might suggest. In the final part, we will bring everything together and explain why the recent correction may eventually be remembered as a temporary pause before the next major move higher. We will also discuss what long-term investors should be watching most closely as gold and silver enter the next phase of this market cycle. As we bring everything together, one conclusion becomes increasingly difficult to ignore. The recent decline in gold and silver was driven by powerful short-term forces, but those forces are beginning to lose momentum. At the same time, the long-term drivers supporting precious metals remain firmly in place. That combination deserves the attention of every serious investor. Markets rarely reward those who react emotionally. The biggest opportunities often appear when uncertainty reaches its highest level. During corrections, many investors focus only on falling prices, while experienced investors begin asking whether the long-term story has actually changed. In today's market, the answer appears surprisingly clear. The global economy continues facing structural challenges that cannot be solved overnight. Inflation remains above long-term targets in many areas. Government debt continues expanding. Central banks remain cautious. Geopolitical uncertainty has not disappeared. Supply chains continue evolving. These issues continue influencing financial markets every single day. Gold remains one of the few assets that has repeatedly demonstrated its ability to preserve purchasing power during periods of uncertainty. It has survived every major financial crisis of modern history. It has protected investors through inflation, banking stress, currency weakness, and economic recessions. That long record continues attracting both institutional and individual investors. Silver may now offer an equally compelling opportunity for a different reason. Unlike gold, silver benefits from industrial growth as well as investment demand. Every new solar project, every electric vehicle, every advanced semiconductor, every artificial intelligence data center, and every modern communication network requires silver in some form. Demand continues expanding while global supply remains relatively constrained. That combination creates a foundation that many investors believe has not yet been fully reflected in market prices. History shows that silver often spends long periods moving quietly before suddenly accelerating higher. Once momentum builds, the market can move much faster than many people expect because of its relatively small size compared with gold. This does not mean prices will move straight upward. Volatility will almost certainly continue. Economic reports will continue surprising investors. Federal Reserve officials will continue adjusting their outlook as new inflation and employment data become available. Treasury yields will continue responding to changing expectations. the dollar index will continue influencing commodity markets around the world. These short-term fluctuations should be expected rather than feared. Every major bull market includes periods where confidence weakens before recovering again. Investors who understand this cycle are often better prepared to remain focused on long-term opportunities instead of becoming distracted by temporary market noise. Another important factor involves global investment behavior. Large institutions, pension funds, hedge funds, family offices, and sovereign wealth funds constantly adjust portfolio allocations based on changing economic conditions. Even relatively small increases in precious metals allocations by these large investors can create meaningful demand because the physical gold and silver markets are much smaller than global stock and bond markets. Central bank buying also remains an important source of support. Many countries continue increasing gold reserves as part of long-term diversification strategies. These purchases are generally based on strategic financial planning rather than short-term speculation. That steady demand continues strengthening the overall gold market. Silver could eventually benefit as private investors recognize many of the same economic risks that central banks already acknowledge. Another development worth watching is consumer confidence. If households begin reducing spending because of economic uncertainty, growth could slow further. If inflation remains persistent while growth weakens, the economy could face an especially challenging environment. Such conditions have historically increased interest in defensive assets, including precious metals. At the same time, technological innovation continues creating entirely new sources of silver demand. Artificial intelligence, cloud computing, renewable energy, electric transportation, advanced robotics, and next-generation electronics are no longer future concepts. They are becoming part of everyday life. Every expansion of these industries increases long-term demand for one of the world's most important industrial metals. Very few commodities benefit from both technological growth and financial uncertainty at the same time. Silver does. This is why many analysts believe investors should watch not only daily price movements, but also broader economic trends. Inflation, interest rates, manufacturing activity, industrial demand, central bank purchases, mining supply, and currency markets all provide valuable clues about where precious metals may head over the coming years. No one can predict the exact timing of the next major rally. Financial markets never move according to a perfect schedule. However, the ingredients that have historically supported higher precious metals prices continue developing beneath the surface. A softer dollar could improve international demand. Lower Treasury yields could increase the attractiveness of non-yielding assets. Continued central bank buying could strengthen gold. Expanding industrial demand could support silver. Limited mining supply could amplify future price gains. Together, these factors create an environment that deserves careful attention. Successful investing has never been about chasing headlines. It has always been about recognizing long-term trends before they become obvious to everyone else. The recent correction may ultimately prove to be nothing more than a pause within a much larger story that is still unfolding. Only time will reveal exactly how this cycle develops, but one thing is certain. Gold and silver remain among the most closely watched assets in the global financial system for good reason. They continue responding to inflation, monetary policy, currency movements, economic uncertainty, and technological change in ways that few other investments can match. That is why staying informed remains one of the greatest advantages any investor can have. If you enjoyed this analysis, make sure to like this video, subscribe to Silver and Gold Watch, and turn on notifications so you never miss our latest updates on gold, silver, the Federal Reserve, inflation, the US dollar, and the global economy. We truly appreciate your support, and we would love to hear your thoughts in the comments. Do you believe the recent correction is over, or do you think another pullback is coming before the next major rally begins? Thank you for watching, and we will see you in the next video.